1929, 1987, 2000, 2008. These 4 years are carved into the bones of the American stock market. On the surface, they have almost nothing in common. One was the age of a new industrial boom. One was program selling. One was the internet. One was housing and financial engineering. But put them side by side, and one pattern starts to feel almost uncomfortable. Before every crash, the market told itself the same sentence, 4 times, almost word for word. What was that sentence? I will hold that answer for a moment. Let's walk through the 4 cases one by one. By the end, you will recognize it yourself. And today, as I pushes the Nasdaq higher and higher, that same sentence may be starting to echo again. This is not a history lesson. This is a 100-year market mystery. Well, I repeat history. Do not answer too quickly. Because what really repeats is often not technology. It is human behavior. This is Future Alpha. Start with 1929. It is the most famous crash in American market history. Cars, electricity, radio, assembly lines. A new industrial age was pulling America forward. Newspapers talked about permanent prosperity. Banks encouraged people to borrow money to buy stocks. Everyone seemed to be talking about the market. The dangerous part was not that people believed stocks could rise. The dangerous part was that people believed the new era had defeated the cycle itself. Then came October 1929. The market began to fall. Over the next few years, the Dow lost almost 90% from its high. Household wealth was torn apart by price quotes on paper. Remember this one. What they believed was simple. Prosperity would not end. Now look at 1987. This one was stranger. There was no classic economic collapse. Companies did not suddenly stop making money. But in a single day, the Dow fell more than 20%. That day became known as Black Monday. Where was the problem? At the time, many institutions had fallen in love with something that sounded very smart: portfolio insurance, program trading. In plain English, when prices fell, the system sold automatically. That selling pushed prices lower. Lower prices triggered even more selling. Everyone thought they owned insurance. But the insurance itself became the fuel. This time they believed risk could be controlled by a model. Then came the year 2000, the dot-com bubble. In many ways, this is the case that looks most like today, not because the internet was fake. It was not fake. The internet really did change the world. The people who were bullish on the internet were right about the direction. So where was the mistake? They turned a correct direction into the belief that every price was correct. They believed that if a company had the word internet attached to it, it would eventually become a winner. Cisco, Yahoo, portals, online retailers, pet e-commerce. For a few years, stories were worth more than profits. Traffic sounded better than cash flow. The word future could cover almost every blank space on a financial statement. Then the bubble broke. The Nasdaq fell almost 80% from its high. Many companies that had been treated as gateways to the future did not even survive the doorway. Remember this one. They believed valuation no longer mattered. Finally, 2008. This time, the main character was not technology. It was housing. Wall Street sliced mortgages, packaged them, repackaged them, and stacked one layer on top of another. Ratings agencies gave their stamps. Investors around the world rushed to buy. Underneath it all was a belief so simple it almost sounded innocent. U.S. home prices would not fall nationwide at the same time. Then Lehman collapsed. The financial system looked as if someone had pulled the power cord. Global markets fell together. This time they believed housing could not fall. Now put the 4 cases together. In 1929, they believed prosperity would not end. In 1987, they believed models could control risk. In 2000, they believed valuation no longer mattered. In 2008, they believed home prices could not fall. Different assets, different technologies, different decades. But read those 4 beliefs together and you hear the same voice. Prosperity will not end really means this time is different. Models can control risk really means this time is different. Valuation does not matter really means this time is different. Housing cannot fall really means this time is different. That is the sentence. This time is different. It is the most expensive sentence in market history, not because change is fake. Change is real. Technology is real. Productivity can be real. New industries can be real. The problem begins when a real story becomes a license to ignore price, leverage, and risk. That is when a good idea turns into a crowded trade. So what about AI today? Is AI fake? No, AI is real. It is already changing software, chips, data centers, search, advertising, coding, medicine, and enterprise workflows. But that is not the real question. The real question is different. How much of that future has already been paid for in today's prices? Because great technology and a great stock price are not the same thing. That was the most painful lesson of the dot-com era. The internet won. Many internet stocks did not. The industry survived. Many companies disappeared. The direction was right. The price was wrong. That is why AI does not need to be fake for investors to lose money. A real revolution can still produce a bubble. A real leader can still become overowned. A real growth story can still be priced, as if disappointment has become impossible. So which past crash does today look like? It does not look exactly like 1929. That was a broad leverage mania across a young industrial economy. It does not look exactly like 1987. That was a market structure shock, where selling rules fed on themselves. It does not look exactly like 2008. That was a credit machine built on housing and leverage. The closest comparison is still 2000. Not because AI is the same as the internet, but because the psychology is similar. A real technology appears. A few companies show real growth. Capital rushes in. The story becomes too easy to believe. Then the market starts treating the future as if it has already arrived. There is one important difference. Many of today's leading AI companies have real revenue, real profits, and real cash flow. That makes the story stronger, but it can also make the story more dangerous, because a true story can be more seductive than a false one. When the story is false, people eventually doubt it. When the story is true, people use the truth to justify almost any price. That is the dangerous part. If a stock goes up, people say AI is transforming the world. If it goes down, people say it is just a buying opportunity. If earnings beat expectations, they say the thesis is confirmed. If earnings miss, they say the opportunity is still early. Sometimes these explanations may be right, but if every price movement can be explained as proof that the original belief is correct, then the belief has lost its ability to correct itself. It no longer helps you understand the market. It protects you from having to think. So will I repeat history? I do not know where the top is. No one does, but I do know one test. When the market is still arguing, risk is not dead. When the argument disappears, risk has started to wake up. So the important thing now is not to shout "I bubble," and it is not to shout "I will rise forever." The important thing is to watch a few simple facts. Can profits keep up with the imagination already built into prices? Are the crowded buyers still adding or quietly leaving? Does the market still allow someone to disagree? As long as those questions remain open, do not turn belief into a conclusion, and do not mistake a beautiful story for a margin of safety. A technological revolution can be real. A market clearing can also be real. Both things can be true at the same time. This is Future Alpha. If you want to look at markets through history, capital, and human behavior, follow the channel. See you next time.